anyway, thank you. We're going to move on, and I'm going to introduce our next panel, which is, on the latest developments in the clean tax cut concept. But let me just tell you, a little bit in that the purpose of this meeting here at the Clean Capitalist Leadership Council is to bring together clean capitalist doers and donors with the policy groups that are working on ideas that remove barriers to clean free enterprise and conservation. And it's a remarkable policy paradigm because it's a paradigm that both sides of the fence can walk into. And Andy represents one end of the spectrum of the folks that we work with. And we work with others too, folks like David Levine and NRDC and all kinds of different groups across the spectrum. But they're willing to work in this space because of the ideas that we're bringing to the table resonate. The idea of opening up public participation and removing barriers to free activity and for good things resonates with everyone. So with that thought, I just want to move into telling you a little bit about the work that has been done in the last year on clean tax cuts very briefly. The key things that have gone forward is the effort led by Steve Nadell here and the American Council for an Energy Efficient Economy, pulling together a charrette of participants to try to figure out how to pull together all the clean tax cut ideas from across multiple sectors that were developed in 2017. Take those concepts and pull them together in what might be a single piece of model legislation. And we went through a lot of different thoughts about how that should happen. First we thought, oh, maybe it should be, clean tax reform. And then that ship sailed, and so we said, well, maybe we should tie it to the administration's infrastructure plan. And then we realized that nobody liked the administration's infrastructure plan, and it was a really bad idea to tie it to that. So we just decided, well, you know what? We should really just decide to design this as a standalone act that exemplifies barrier removal. In terms of the clean tax cut concept. And that is what we did, and we tried to make it as simple as possible by going with the most powerful clean tax cut idea. Excuse me, Todd. Todd, could you get Travis, because I'm going to mention him in just a second. He's on the phone. Well, Travis, he's going to miss it. But we went with an idea that was, really pioneered at Columbia University by a working group led by Travis Bradford called the Clean Asset Bond. Travis had suggested that, way back at the first charrette that, if I as a supply sider was focused on all kinds of solutions that could be provided by the automobile sector and the power sector, and these were supplying clean solutions potentially, but they were on the demand side of capital. And he pointed out that if we went to the green bond market, you'd be on the supply side of capital, and the idea would be particularly powerful. So Travis's idea of applying it there and leading a charrette at Columbia to do it led to the creation of an idea called the Clean Asset Bond. And the Clean Asset Bond is the core building block of the Clean Free Market Act, the core building block that builds a clean free market. And what it is a leveraged incentive, the only leveraged incentive that's ever been devised. When you talk about tax-exempt bonds, almost virtually all of those are government bonds. So on the other side of the debt is government. There can be no leverage effect. It's like pushing on a block. It doesn't work. But if you put that bond in the private market, and you're financing assets that have a historical track record that is proven and pre-qualified, then you have a leverage effect like this. You're pushing down over here on the cost of capital, and from that you're getting all kinds of great effects. Cheaper costs of clean cars, cheaper cost of clean power, which is driving more demand and participation. But over here, you're raising the return on equity. Push down the cost of capital, you raise the return of equity, and that's why capitalists have used leverage for years. That's what investing on margin is. You boost your equity returns. That's why companies use debt for project finance, because it raises the equity returns. It's cheaper money. They're boosting their returns by doing that. And the clean asset bond magnifies that. So the remarkable thing about the clean asset bond, there are several more remarkable things. Remarkable thing number one is that you're attracting investment both to the tax-exempt bond and to the boosted equity. The boosted equity is attracting. Remarkable thing number two is that the boosted equity is attracting every investor. The real problem with municipal bonds is that they attract only a very narrow category of investors in one state, the high net worth individuals in just one state. That's a very narrow, illiquid, thinly traded market, which means that they're losing approximately half the value of the tax exemption to illiquidity risk because of that. It makes the cost of municipal finance much higher than they need to be. So just putting it in the private market drives down those costs. But the same is true, by the way, of tax credits. Tax equity financing only appeals to the various highest, the highest income taxpayers, like the Berkshire Hathaways of the world. Everybody else is at a disadvantage. Only those guys can use all that tax equity. Everybody else has to go trade it with a banker and lose a lot of the value to the bankers. Makes it a very constricted market. Mom and pop can't play in it. This breaks through all of that. The equity appeals to everybody. Middle income, mom and pop can invest in that. The middle income investors, mutual funds, tax-exempt pension funds, everybody. So you're going from an investor base like that to an investor base like that for these things, and you're getting investment here and here. The third remarkable thing about it is that you're giving up tax-exempt equity, you're giving tax exemption here where the U.S. ROE is 4%. Return on debt is 4%. Return on equity is about 13.6 right now. And there is Travis Bradford, the man himself who his core idea led to the creation of the clean asset bond. His original idea was called the emission reduction bond. It was purely for clean zero emission power sources, but we spread that out a little bit. But the remarkable thing is that you're giving up the tax exemption on the cheap side, and you're keeping taxes where the returns are 360% higher per dollar of investment. That means that the clean asset bond is potentially the only incentive that is closer to being revenue neutral. God knows, maybe it's going to be even revenue positive. We're not going to know until we actually do it, and I don't want to make any claims that jump the gun, but I'm just pointing out that there's more incoming revenue associated with this incentive than there will be with any other incentive that's ever been designed, and it leads to a more participatory market than any that's ever been designed. So that's game changer number one, is the clean asset bond. Game changer number two in the Clean Free Market Act is something which I think is going to appeal very, very much to governors. I think that it may be a little bit too innovative for Congress right now, but I think they will come along. And that is a feature which we've taken from tax treaties known as tax reciprocity. Tax reciprocity is a very simple thing. It says that, we'll treat French tax-exempt organizations as tax-exempt in the United States if they treat American tax-exempt organizations as tax-exempt in France. Simple reciprocity. We bake that right into the Clean Free Market Act. So it turns the act into the free market version of an Xbox, free market legislation version of an Xbox. Basically, you plug it in, you're part of a vast online world. You enact this act, you're part of a vast clean free market, in the sense that you enact this and your businesses and citizens can issue clean asset bonds and loans that are tax exempt, not just to your citizens, but the citizens of every other nation that also, and any other state that also implements this act. So you're immediately enacting it, and you're playing, it's a way to create something that looks like a free trade zone or a carbon trading market, but without the need for negotiating the treaty. It's simply plug and play. It speeds up adoption greatly, starts that. So, but these are all, very cutting edge, concepts, and they're, the latest version of the act that Steve has done for Congress makes sure that last feature is optional, because he's worried that it might be too much for congressmen. But in any event, we've also done, there's been some remarkable work done with Doug Woodring of the Ocean Recovery Alliance, who's coming up here in a minute, and on figuring out how clean tax cuts will apply to plastic, which you'll hear about. And Michael Mealing, from the deputy director of the MIT CEPR, which is the Center for Energy and Environmental Policy Research, is leading up an effort to write the first academic articles on clean tax cut, which will appear in peer-reviewed journals. And with him on that effort is economist Wayne Weingarten, who has been advising me on the clean tax cut concept since 2015. Wayne is an associate of Arthur Laffer's, who helped co-author the influential Laffer's influential paper on the supply side dream version of the carbon tax, which it influenced a lot of folks. It led a lot of folks in the carbon tax world to say, see, free market economists believe that carbon tax is a good idea. And it's the version of the carbon tax, I think, that, the more conservative proponents of it, like R Street Institute, favor. Now, Wayne is writing the first paper on comparing clean tax cuts to a carbon tax and to other kinds of incentives, and he can talk to you about that work. With that, I'd like to welcome up our panel, and we can start talking about that work. And we are running a little bit behind, so we'll run through that and try to leave some time for Q&A.